Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist for Options Play, and today we're going to talk about hedging your portfolio. The market has been setting new highs, and we're going to look at, first of all, the most basic option strategy that you can do on an individual stock, which is just buy a protected put. And then we're going to look at some alternatives to that strategy by looking at put spreads, and then talk a little bit about index options and how they might be used to hedge your entire portfolio. So with that said, before we get too far along, if you have any questions, please do put them in the Q&A box. The chat box is disabled, and that is only meant for the panelists. If you have any questions, you will look for the one that has a little question mark on it in your offerings inside this platform. And if you click on that, I will try to address any questions that you may have during the event. So with that said, let's get started. At Options Play, a lot of times we'll even show you inside the platform some real live securities. Nothing's meant to be a recommendation. Past performance isn't a guarantee of future results. And as far as first trade is concerned, if you're going to trade options, you should receive a copy of the characteristics and risks of standardized options. It's all over the First Trade platform. You can always just download it by clicking a link, or if you would like a paper copy, you can ask for them. They'll send you one, or any exchange will send you one that trades options. And let you know that options are risky, and you do want to make sure that options fit within your profile, because you can potentially lose all of your investment into one particular option trade. All right. So let's jump into it. Now that I've scared you a little bit, let's get into the agenda for today. We're going to talk about rights and obligations. We're going to look at a protected put on an underlying stock. We'll talk about index options and the math that's involved with looking at an index, and then things to think about. We'll talk about, and this is probably the most important slide of the entire presentation, is to understand that if I'm looking at a protected put, what are some of the things that I want to understand within that protected put once I put that position on? It's easy to put a position on, but what do you do after you have your protection on? And that's what we're going to look at today, and that's what we're going to focus on. So, for example, if we look at the four basic trades that you can do with an option, we've talked about calls and selling calls, but today we're going to focus on this side of the equation. We're going to look at buying puts, and if you buy a put, you have a right to sell the underlying stock. Now, a lot of people come to the options marketplace and they think about the leverage that options provide. And that is just such a small part of the entire options marketplace. And honestly, that's not even where options first came from. Options came from a need to protect your underlying, to protect an asset. And because of that, there are a lot of terms in the insurance world that get transferred over to the options marketplace. For example, if you pay for an option contract, they say that you are, or if you get a quote on an option contract, a lot of people will say that you are getting the premium for that option contract. Just like if you buy car insurance, you say you're buying the insurance and getting the premium that you're paying for that 6-month insurance policy. And then also when somebody sells an option contract, they're often referred to as the writer of the contract. Just like in the insurance world, you call that the underwriter. So the put side of the equation is really where options first originated, but then obviously calls came along, and once the Chicago Board Option Exchange in 1973 started trading listed options, calls were more popular than puts at that point in time. But where these terms come from is a put means that you have the right to put stock to somebody, and hence the protected put. I can fixate a sell price, and I can put that stock to you at that price. Call options mean you have the right to call stock away from you. So that is where the terms come from, but we're going to focus on the put side of things today. All right. So if you do have any questions, do feel free to put them in the Q&A box. So we're just going to look at a generic example on XYZ. Now, this was a real stock. I don't even remember what the stock was when I put the slide together. But with that said, $86 stock. If you want to buy pure insurance here, if you want to buy the expensive insurance, the lower deductible insurance, right? We're going to buy something that is, in this instance, it's going to be $1.60 out of the money. So how do I think of all of this as an insurance product? We're looking at this example as XYZ, which wasn't a stock at one point in time, but now it's an actual symbol. But with that said, this is a fictitious stock. It's trading at $86.60. Very rarely do you buy the stock and then buy a protected put, because you're buying the stock usually because you think the market's going to go up, and you don't necessarily buy protection right away. Not saying that you can't, I'm just saying that that is not the norm. But in this instance, we're going to look at it as if the stock was trading at 86.60. We decided to buy a protected put to protect our downside on the underlying stock. We're going to go out 30 days. We're going to pay $1.20 for that. That is the net debit. That means that our total cost basis on this position is $87.80. The 120 plus 86.60. If we're going to buy 100 shares, our total risk would be $8,780 plus any commissions or fees that you would have to pay to get into the trade. That once we do that, we have limited and known downside. So in our example here on our profit and loss graph, just a very generic example, from 85 on down, we have the right to put stock to somebody. So from 85 on down, our loss is limited and known, and it's going to be the difference between where our cost basis is and where our strike price is at. But we still own the stock, so we have unlimited upside potential from owning the stock. So here's our max risk. 86.60 minus 85 is $1.60. Plus down to $85 is $1.60. Plus that net debit, just like in the insurance world, right? If you happen to buy car insurance and then run your car into a tree, they don't say you are right, you're a horrible driver, here's your premium back, right? No, they give you a new car, but you don't get your premium back. So with that said, that's also true in the options trading world. So this is a cost of doing business. So if I do buy this protected put, $1.60 out of the money, my total risk over the next 30 days is going to be $2.80 or 3.6%. I still have unlimited upside on that underlying stock. And that's all caused by the fact that you own the stock. You didn't sell the stock. Now our break even has increased because we do got a cost here. So 87.80 is the net debit paid, and that's where our break even is at. But I'm going to go all the way back to the fact that if I'm doing this, I'm doing it because I'm still bullish, but I'm nervous. I'm nervous about something. Now, it can be an event. It can just be that you've had a good run up in the stock. The underlying stock has made a precipitous move to the upside, and you just want to make sure that you lock in some of those gains. And a protective put is a great way to do that. A lot of people think of using stop orders where I've had the market move up. Now I'm going to say, okay, if it retracts a little bit, I'm going to put a stop order in to sell my stock at the market if it hits a particular price below the current underlying stock. This is a time where I kind of like protective puts. And here's the reason why, is that you're not doing it in a panic situation. You're not doing it because of a known event like an earnings, but you've had a good run up and you're like, okay, I think we can get some more. Let's take some of our profits and let's buy this put and protect us for the short term. Now, if I do this, I like to say I'm bullish but nervous. You still want the market to go up. You don't want to be upset. Are you upset if you buy car insurance and you don't crash your car? Right? No. You want that to expire ideally. Now, in the options trading world and the stock market, you have the potential that the gain on the stock can offset the cost of the insurance. That doesn't usually happen when you're buying car insurance, right? Usually your car doesn't increase in value over the life of the insurance policy. So that's one of the benefits of insurance in the stock world. But if I'm doing this, that is, to me, the ideal scenario when I would buy a protective put. The market has ran up. I want pure insurance and protection on the downside. And then I'm not forced to sell if it hits 85, right? So let's paint a picture here. The underlying market started at, let's say, $65. So basically it's up 20 points and some change, right? And I've had that run up, and maybe a major event happened. I don't know, but over the last 3 or 4 months, we have a ginormous gain in the underlying stock. And a lot of people will then come in and say, well, obviously the stock's not going to go down. Why would it go down when it's ran up so much, right? And if you have any experience in the stock market, a lot of times you know that stocks don't usually just go straight up. Some have tried, but very few achieve the straight up thing without taking a pause from time to time. So stocks at 65, it runs up to 86.60, and you say, okay, this is fine. It's going to keep going. Before you know it, the stock comes down and now it's trading at 80. And you say, well, all right, if it gets to 86.60, if it gets back to that high, I'll get out. Before you know it, now it's at 75. And you're like, wow, what just happened? And then you turn around and it's trading at 65 when you got in, and you sell it and you say, whew, I didn't lose anything, right? That scenario has happened to all of us, and me included, right? Where you had a stock run up, it had a big gain, and all of a sudden it gave it all back not that much later. And it all depends on the underlying stocks that you trade, but that's a viable example. Sometimes it makes sense to just buy that protective put. You buy the 85, you give yourself 30 days, you spend a little bit of that gain that you have. And here's what's wonderful about it is if the market does go down, let's say we painted a picture in the short term and all of a sudden it's at 75, you can just sell the put and remain long the stock. You don't have to exercise if you don't want to. You have that ability to just close that position. You're in control, and you can decide when you want to close that position. Now, the downside is that if the market continues on up, or the downside about puts in general is that if it's on a stock that's more volatile, it's going to be more expensive. If you are buying car insurance on a Bentley, a very expensive underlying car, as opposed to a Ford Taurus, right? It's going to be more expensive to buy that car insurance. And keep in mind that that's also going to be the case in the stock market. And if you are a volatile driver, if you've had a lot of speeding tickets, if you've had a lot of accidents in your driving, it's going to cost you more because you're a more volatile driver. And that is also the case in the stock world. The more volatile the underlying, the more expensive the insurance will be. And I'm totally pushing this as an insurance scenario. So with that all said, I like a protective put in a scenario where you've had a decent run up on your underlying stock and you truly want to give up some protection, and you're saying if it's going to continue on up, that's great, but it's going to get you through this little sketchy period where you've had a big run up and now you're a little bit nervous about losing it. And some people might just sell it. I mean, let me think of I had a stock where I just recently did that in. Oh yeah, I was just in general. There's a couple of them, a couple of stocks where I've had big runs up, and before you know it, they came back down. Boeing was a real good example of the underlying stock going up to a certain level. I decided, well, that's where it needs to be, and had a solid run up, and then before you know it, Boeing gave all of those gains back. And that would have been a perfect time to buy a protected put. And I wish that I would have. Instead of selling the stock, I would have actually gone out and bought the protected put, because before you know it, Boeing went back up again in that scenario. So I'm just trying to give real life examples of underlying stocks where this type of scenario might have happened. And spending a little bit of a capital gain every once in a while is something that you should have in your back pocket. I don't think of this as I'm going to do this all the time. If you're going to do this all the time, you should just get out. And the fact that we went out 30 days is a great example. I don't like to buy 90-day puts. And if I'm going to go out 90, 120, 140 days, the downside is with a stop order, it's easy to adjust it, right? If the market ran up, it's at 86, you put a stop order in to sell if the market comes down to 85. Well, if I want to adjust it and all of a sudden I turn around and the stock's trading at 100, well, that's an easy thing to do. You just cancel that trade and add it in and say, okay, it's at 100 now. I'll stop myself out when it gets down to 95 in that scenario, right? In the options trading world, you'd have to roll your puts up. You would have to close the put if it's got anything, any value in it, and go up and buy another one. And insurance can get pricey. So I'm going to use it as a time-to-time scenario, not as this is the way that I'm going to trade, where every 30 days I'm putting on a new put, and every 30 days I'm going to try to protect that portfolio. All right. So with that said, that is the protected put scenario in this stock on XYZ. Now, another scenario is if we come in and use a put spread. Now, I talked about expensive underlyings. This would be my favorite strategy to do on a stock. Well, gosh, one that's just been crazy, that's been going on, that's fairly expensive, like something like NVIDIA. NVIDIA's making some headways, and it's a little bit more pricey, a little bit more expensive stock. You have some volatility, some predictability, but I'm going to protect it within a range for that underlying stock. So in this example, let's walk through it, and then I'll talk about what might happen in an NVIDIA example, right? XYZ stock's at 86.60. So instead of just buying the 85 strike put, paying 120 for it, we're going to say we're not worried about from 82 on down. So I'm going to sell some of that protection. And I'm going to buy this put, and then I'm going to finance it by selling a put at a lower strike. So now I do make money from from 85 down to 82. I can make a potential extra $3 or $300 on my 100 shares if the market does go down. It gives me limited protection, but now my net debit is quite a bit lower. So it's 120 minus that 45 plus the 86 plus the 86.60. So 120 minus 45, and it makes your break even at 87.35. 87.35. So our max risk would be the difference, the deductible from 87.35 down to 85, or $2.35 versus 280. But we have no help below the 82 strike. Still have unlimited risk reward. Break even is at 87.35. Now, in this scenario, on this underlying, it's not as enticing. If we look at the profit and loss graph, let's compare the two. I'm going to jump up to the slide previous on this, okay? And we see that we have limited and known downside, unlimited upside on that underlying stock. We're still going to have that unlimited upside, but we have our insurance stops helping us. We have a plateau, and it goes from 82 on down. That's where we have the most of our risk on that trade. So if I'm doing this, I still own the stock. I have unlimited upside, but I have limited and known downside on that underlying. So with NVIDIA right now, we currently see the underlying stock trading at, it's up $6.90 on the day. It's at 177.68. So in that scenario, I could go out and buy the 175 strike call and then sell the 165 strike call and give myself 10 points of protection and greatly reduce my overall cost on the protected put. Very simple, very straightforward, but that would be the protected put example that I would be looking to do. If I have an expensive underlying and made a good run up today, NVIDIA has had some issues. Well, I guess the stock has struggled ever since they've had some earnings. So now, is this true? Is the market going to stay this way? Are we going to still get that momentum to the upside? How about we go out and do a protective put spread for the next 15, 30 days, see if this holds. And, it's a great time to be thinking about this because we're in September and October. And that's part of the reason why we put this seminar together. Markets are usually more volatile in September and October. There's no real rhyme or reason to it. But here's a great example where you may have been down a little bit on NVIDIA. You want to come in and use some protection, use options as they were first intended to go out and protect your position on a particular underlying stock. Now, don't want to go out much more than 30 days is usually the maximum that I'd want to buy a put. It all does depend on volatility in the underlying. If you have a lower volatile stock, you might go out a little bit further in time than a higher volatile stock. But ideally, mainly because of the cost, and that's the biggest reason why we would want to go through that scenario there. So now, if you want to protect an entire portfolio, the math is fairly simple. But the biggest thing that you want to do is look at the underlying that represents your portfolio. So if you have a lot of tech stocks, you want to look at it in the NASDAQ. If you have a lot of large cap stocks, you might want to be in the S&P 500 index. Or if you want to do an equal weighted index, and whatever is available, whatever underlying you think matches your portfolio, you can buy some insurance at a cheaper price and hope that you get good representation on your put options. So, for example, very simple math on this, on how you want to calculate the amount of your portfolio. So right now I have the S&P 500 index, and I'm going to round off here a little bit, at $6,540. So if I want to buy a portfolio and I buy one put option in the S&P 500 index, you take the value of the index, 6,540, and you multiply that by 100. And one put option then would represent $654,000 of portfolio. So by taking that value and buying one put option, you can protect a large part of your portfolio. Now, it's going to be dependent on how your portfolio reacts to that marketplace. And then you got to decide, well, what is my strike price? What would I want to buy to try to protect my portfolio? How much of a deductible do we want to take? In our instance here, we're taking from 86.60 down to 85. We're doing $1.60 before our insurance kicks in. On the S&P 500 index, what put option would you want to buy? Would you want to buy the 65.30, 65.20? What is the percentage that you are willing to take before your portfolio insurance kicks in? Now, this will be cheaper on a cost basis than buying insurance per underlying stock, but also realize that it's going to represent a large part of your portfolio. So you just take the multiplier of the index, which is 100 in the SPX, and you multiply that by 100, and that gives you the amount of portfolio protection that would cover. Now, if your portfolio isn't $650,000, well then Maybe look at the SPY. The SPY is the ETF that tracks the S&P 500 index. And you can do it much the same way. So if I look at the spiders, that's trading for $652.79. So take the multiplier, which is 100, multiply that by the SPY value, and you come up with a valuation of portfolio that a protective put in the SPY may protect. So in this example here, we're looking at 652. That's where the underlying is at. I'm going to round off $652, multiply that by 100. You're looking at $65,200 of portfolio value. And if you had 120,000, you'd look to buy 2 of them. Now, your biggest example here is if I'm going to do this in the SPY and I'm going to try to protect myself, there are advanced strategies called beta weighting, trying to beta weight your portfolio versus the S&P 500 index. I think it's a little bit more advanced. I don't look at it that way. If I'm buying protection for my entire portfolio, I am not going to get that granular on that position. Hedge fund managers, they definitely are going to do that. And if you have a large enough portfolio that's sensitive enough, you can take the time to look at beta weighting your portfolio to see how your portfolio matches the underlying. But there's a lot of fudge that's in the beta. You know, beta tells you how your stock is supposed to react on the upside and on the downside compared to a particular underlying like the SPY. So that's where the definition comes from. But that is one way that you can approach it. Now, if you have more small cap stocks, you can look at the Russell 2000 index or the IWM, and that's a different way that you can adjust your portfolio and look at managing the risk of an entire portfolio of small cap stocks. And that's the way that we look at it, and that's how we would approach it. All right, so if you have any questions, please do put them in the chat box. But here's the things that I want to think about, and feel free to address any of the questions that you may have. But I'm going to start going through this list, and then I'm going to open it up for questions to all. All right. Do you have to exercise your put option? And we kind of address this. Now, the one thing that's wonderful about this is that you have the control. You pay cash. You have control of when you may exercise. And a lot of times, if I buy protected puts on underlyings, I'm just going to sell it. I'm going to buy it. The market goes down, sell the put, remain long the stock. Now, if it's in a you know, we don't give tax advice, but if it's in a taxable account and you manage the put, you're just dealing with the gain on the put and not have to worry as much about the stock. So there are some times where just selling the put and remaining long the stock may work. But also this means that don't be worried about the fact that you're going to exercise your put and sell the stock, right? In other words, you're going to take on that capital gain. Maybe you've owned the stock for a long time and you don't want to have to sell it because of tax purposes. So you buy the put option, it still gives you the protection, and then you have the option to just sell and close the put option in the marketplace and not exercise it. Now, if you're looking at an index of it, if you exercise a put in the SPY, right, you're going to be selling SPY shares. So you need to manage that if it's in the S&P or SPY or an ETF that tracks an index. And you're not going to be selling the shares of stock in your account, right? So keep that in mind. Are you bearish on the stock? The answer is no. And I think what really sets this scenario home is, I mean, do you buy your car insurance and hope that you run into a tree before the expiration? No, you don't want the market to go down. The only thing that would give you prowess is to say, yeah, I was right. The market, I knew the stock could go down, right? So it's bragging rights. But ideally, your best case scenario when you buy a protected put, when you buy a protected put spread, is that the underlying market goes up, and it goes up at least the cost of the insurance that you bought. Do you need catastrophic insurance? So if you don't, and it's expensive, and you're talking about underlyings in the tech area, Meta, a lot of the Meg 7, Meta, Nvidia, even well, a real good one. This is a stock actually going through my mind and thinking of stocks where protected puts or protected put spreads could really work well is in a stock like Netflix. It's had it's had a very strong move here. It's been a darling of the stock market. No tariffs are affecting anything in the Netflix world, and uh, they just keep putting out great content. And everybody says that they're overvalued, and they've been overvalued, I think, since they became public. And so you get a big run up in Netflix, buy some protection, take the protection off, let Netflix run again. When it happens, buy some protection. And over time, Netflix has done very well. I personally have bought Netflix many years ago, like at 100 and then sold it at 150, where a protected put would have been a great alternative. And this is one underlying where you have enough volatility to the upside, and it's been to the upside. Obviously, you got to get that right, or it's never going to work. Protected puts aren't going to make money unless the underlying stock goes up. But that is a great example of a stock that instead of selling, if you bought protection and you kept adjusting that protection whenever you got a 10 or 20 or 15% move in the underlying stock, this would be one great way to do it. Is constant put buying cost effective? No, I don't think so. Netflix would be a great example, but I would want to have a plan. If I'm doing constant put buying, it's got to be when the underlying makes a significant move, 20, 30, 40%, buy a protected put. Market comes down, sell the protected put. You get the run up again, buy a protected put. So you have to have an egregious move to the upside, a volatile move to the upside. And Netflix is one example of a stock where that would have paid out without a doubt. What expiration should I choose? Well, if it's a volatile underlying, I don't ever want to go out more than 30 days. Usually, I don't care if I'm buying portfolio protection, if I'm buying protection on an individual underlying. If you're going out 30, 60, 90 days, well, maybe you're just bearish on the market. Now, if you're a hedge fund and you're trying to manage your risk with deltas and beta weighting and stuff like that, that's a little different. But as a retail client, I don't recommend going out longer than 30 days. And the reason why is that what do you do when the market goes up? You buy that put, you buy that protection, the market goes up. Am I going to go out and roll and buy another protected put closer to the underlying strike? Eventually, those fees will catch up to you in the retail world. So I don't like going out more than 30 days, and I only want to do it in certain situations. And that goes hand in hand with roll up. Have you considered the cost of the collar strategy if you're worried about cost? Now, the alternative and of the put spread is to think about selling a call to pay for the put. Now, here's the downside of selling a call to pay for your protection, and that's called collaring the strategy. You say to yourself, let's go back, and actually I'll pull up this example, see if this generates any questions. I don't see any questions so far in the chat box. But if I go back to this slide, and we talk about a protected put, and the stock is at 86.60, right? And I'm thinking the underlying market is going to go up. Well, I could sell the 90 strike put with the same expiration, help pay for this insurance. But here's the downside of selling the put to pay for the insurance. I don't mind it, but you got to be prepared to sell the stock. You got to be okay with selling the stock. If it's on a stock that you like, and you say, well, if it goes higher, I'm willing to sell it, that's fine. You can try to adjust the trade. You can roll the covered call out in time. You can do that if you would like. But if I'm doing the collar strategy It's really a covered call strategy in my mind. And that's really where it comes from. And I'm thinking of it with that mindset that, do I really want to sell the stock if it gets up to that strike? And if I don't, then what am I going to do? Am I going to have a plan? Am I going to roll the option contract to try to avoid the assignment? I personally like the protective put in different scenarios. Like I mentioned, the Netflix scenario would be a great example. If you did the collar strategy, you would have got pegged on the upside, right? Because Netflix just kept going up and up and up. Retract, go up and up and up. Retract, go up and up and up. And that's the chart, and that's the way the Netflix scenario has gone ever since it's actually came public. So with all that said, all right, that's it. I'm going to leave it right there. My name is Brian Overby. If you'd like to follow me, you can follow me on x.com. My handle's @BrianOverby. Obviously, you have access to a plethora of the search tools inside the optionsplay.com platform within the First Trade platform. And my book is called The Options Playbook if you'd like to learn more. And I don't see any questions, so I must have did a great job of explaining this throughout. All right, I'm giving you one last chance to post some questions. And if not, all right, that's it for this edition of Education sponsored by First Trade. Thanks for stopping in, and I always like to leave you with one little note. I hope may all the option contracts that you buy finish in the money, and all the ones that you sell finish out. Thanks for stopping in.